Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy, and I will be your host today. And really excited to have Ken Gee with us. Ken is the founder and president of KRI Partners based out of Cleveland, Ohio. He has got 27 years in the real estate business with over $2 billion in transactions, currently managing over $200 million in assets under management, and has done 14 full cycle deals. So Ken, welcome to the show.
Thank you so much for having me, Randy.
Awesome, Ken. Well, let's just jump right in if you can. Can you tell us a little bit about yourself and how you became to be the real estate investor you are today?
Yeah, I sure will. Yeah, so I grew up in a small city called Toledo, Ohio. Probably no one's ever heard of it, unless you were a MASH fan, then maybe you have. But I got my undergrad from the University of Toledo in finance, and then moved to Cleveland, where I became a commercial lender for a regional bank, and pursued my master's degree at night at a school called Case Western Reserve University, small private school. Loved the experience. Going from a state school to a private school was quite an eye-opener for sure. But it was, what happened to me, I was a commercial lender, and all my clients kept saying, I don't know, man, let me talk to my CPA. Let me talk to my CPA. And I thought, yeah, come on, I want to be the guy you want to talk to. So I said, all right, let's go be a CPA. So that's what I did. That's what I went to school for, to be a CPA at Case. And did that work for Deloitte for 7 years on the tax side. Did a lot of M&A work, a lot of private equity work, all the fun stuff that you could do if you think of CPA stuff as being fun. But it was there that my kids were very, very young. My daughter was an infant, and I used to do her middle of the night feeding. And for those of you listening who are a dad and who have a daughter, you know that bond is really, really interesting and really cool. And I thought it was really cool, right? 3 a.m, just her and I, everybody sleeping. I mean, it was great bonding time until I realized, wait a minute, Ken, this is 3 a.m. and this is the best you can do for your daughter. And that's when I realized, remember I had a good job at the time. I was doing well at Deloitte. I thought, man, I did everything. Went to school, got good grades, did everything I was supposed to do. And then I just realized that I just built a life for myself that was so busy that I was probably going to miss my kids and my family growing up. And that just didn't sit well. So I embarked on this journey to say, you know what, I got to do something different. Well, as a commercial lender, I had a ton of real estate clients. As a tax person at Deloitte, we had a huge real estate practice at the Cleveland office at Deloitte. And I said, you know what, these people are making a lot of money in real estate. I need to really get into this. So I bought 3 deals, a 28 unit, a 24 unit, 22 unit, sold them 3 years later, made $500,000 and realized this. I need to stop being a CPA, right? If I can make more money on the side than I had up until that point at Deloitte. Nothing wrong with Deloitte. Deloitte's a great place to work. I don't want to diss Deloitte, but it was a fantastic eye-opener for me. And so, 27 years later, I've just, continued to just grow that.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So you did those first 3 projects while you were still employed. And I suspect your income from those was probably comparable to what you made over those 3 years with Deloitte, right?
Yeah, well, remember, this is 25 years ago. So when I started at Deloitte, I was probably less than $50,000 a year, right? So you're talking about, I spent 7 years at Deloitte, but I have to do the math here. I was probably I probably had overlap of about 5 years. So I was at Deloitte. So 4 or 5 years. So I did a lot of this thing. One of the things, we talk to a lot of people every day, they're trying to figure this business out and how to get started. And they think you got to jump from this pond into this pond. And they don't realize that you can have your fingers in both of them And that's what I did, right? You can start real estate on the side, and that's what I did. In fact, it was my job that made me realize I had to buy apartments. I couldn't buy single family homes because I didn't have any more time. I had to buy a business that I could hire people to go do things. And that's what made me start out with apartments.
I love it. I love it. So many people listening to this podcast, including myself, started with the single family space and found out real quickly it's just not a scalable option. So your background as a CPA, the numbers told you very clearly that you need to go bigger, quicker. So you're not actually the one managing the day-to-day of these very large businesses. So I'm curious, when you, like Deloitte, and specifically working in that division within Deloitte, that's a very reputable position, reputable company, very demanding. How did you manage your time while you were doing that? You mentioned that you have a daughter that you got to see basically in the middle of the night. So why not throw in this big multifamily operation into it as well? What did those first few years look like?
Yeah, it was tough. I mean, actually managing the way I had it set up, I would get up before work and do an hour's worth of work. And then at lunch, I would do things as necessary. And then you have your evenings, well, kind of, right? So when you're at a big firm like Deloitte at 7:00 at night, if you have to make a 15-minute personal phone call, is kind of okay. I mean, it's 7:00 at night, you got to give us a break. So I just weaved it in where I could, did a lot on the weekends. What I didn't do is I couldn't turn the units. I never showed apartments. I don't know how to maintain anything. I mean, I couldn't fix anything to save my life, as my maintenance guy reminded me of. So, so that, I don't know if that answers your question.
It does. Yeah. And I think, kind of getting to the point where it's in this multifamily space, it's especially if you're buying assets that are a little bit bigger, you can afford to hire people to do the things that you might not be able to do if you're buying smaller unit, less number of doors under one roof. So
no, and I said that's what actually led me to that 28 unit building, because it's a business, right? And I could afford. I had a great lady that lived on site. She got free rent and a little bit extra money, and she actually ended up growing with me and managed all three of them. She loved being in charge of everything, and she was a wonderful lady. And I mean, it just worked out perfect, right?
Very good. Very good.
I had to leverage myself. She became very good. By the time I sold that third, those three, she did most things. It was really kind of nice, which made me realize the bigger you get, the less harder you work.
Yeah. Yeah. And it's more and more important to find the right people to work for, the people to partner with to do those duties. Because if you hire the right people, they're in good hands. So
they will make you or break you. Yes, sir. You are right.
Exactly. So let's talk about that point. You're working at Deloitte. You had just sold these assets. Was it at that point you decided you're going to leave Deloitte and go full time in the multifamily space, or did it go on for longer?
It was about a year or so later, because I had to remember I sold everything. So now I had a bunch of money in the bank, and I thought, okay, I gotta make this happen. So it was. I think I was around Deloitte for another year and a half, something like that. Before I left. But yeah, it because I was careful, right? I was, everything, the grass always looks greener on the other side. And I was worried that I was going to make a decision here that I would regret later. So I was just overly cautious about doing it. I will tell you, Deloitte, again, that's why I love that firm. They said, Ken, if it doesn't work out, you have a place here. Don't worry about it. All right, go try. And I, most firms don't do that. They just don't. And they were so incredibly supportive. So, I can't say enough good things about that firm.
That's amazing. Yeah. And it's interesting. You hear a lot of people, they have these negative beliefs around corporate America and the bad guys. But I had a similar experience. I spent 11 years with American Express, and I can't think of a negative thing to say about them. Like the time I spent there, the education, the training, the experience that I had, really just set me up so I could be in a position where I could do what I do today, much like yourself. So
Yep.
Well, let's dig into that journey a little bit. You bought and sold the three. You're at Deloitte for another year or so. Did you immediately start scaling the business, or did you take it a little bit slower?
Yeah, it was slow. My problem has always been that I'm a pretty disciplined guy, right? A CPA, go figure, right? But a lot of deals just didn't make sense. So you look at deals, clearly back then I didn't understand numbers the way I do now. I just didn't.
Yeah.
Anybody,
Yeah.
just because I'm a CPA doesn't mean I intuitively understand numbers. It just means
Yeah.
that I'm a CPA. So it took me a while. And the biggest challenge I had back then is, even though I had just made $500,000, you really don't have a lot of liquidity and you don't have a big balance sheet. And all right, so you bought 3 deals. Okay, Ken, you're not exactly Mr. Experience yet, right? Even though you feel like you are and you want to be proud of what you've done, that's fine. But I had to find a partner, and that's the other thing that people just don't understand is you're getting into this business, you're going to have some things you're lacking. And at that time, I lacked the liquidity, I lacked a balance sheet, I certainly lacked experience. Right, 3 deals does not make a veteran, right? At least I didn't think so. And so this guy helped me, and we made a great deal. I did all the work. We didn't put in the same amount of money, and he did extremely well. I did extremely well. But it was through that period of time that I developed that relationship that allowed me to do that, right? And that's what I always share with people. Most people that get into the business and do what we do, they don't start off wealthy. They just usually don't, right? Wealthy people invest passively and give us money to do their deals. That's what they do. The people like us who want to make this their business, you don't have all of those things. So you have to find a way to solve that problem if you want to continue in this business. So I was lucky enough to find somebody who really helped me. And, now we try to provide that for a lot of people that are trying to get started today.
Yeah. So talk about that a little bit. So you were essentially the hustle. You were the feet on the street. You were the guy that was managing the day-to-day operations of this business. Did your first partner, were they just a balance sheet partner, or were they an experienced syndicator operator that was also teaching you more about the business?
Yeah. So no, he was very hands-off. So first, let me just be clear. My first deal I borrowed my down payment and got the other half of it. I became partners with my then in-laws. So we were 50-50. My second and third deals I did on my own. And then I said, okay, we want to buy these deals together. His name was Gary. I'm not going to say his last name. But so we bought these deals together. It wasn't for many, many years that we decided, okay, we should start syndicating. I think our first syndication was 2006 or something like that. I don't remember now. It's on our website. You can see that Crossing is the deal we bought if anybody's ever interested. But what I did was I thought, man, this is going to take forever to grow this way, right? And so I said, what if we went out and raised money? Well, I knew that concept because of my time at Deloitte. I had a bunch of private equity firms as clients. So I thought, let's take this model and apply it to the real estate world. And we did. We syndicated Van Aken Crossing, and then then what happened was we completely changed. I woke up one day and said, man, we're doing well in Cleveland, but what if we actually went to a place where everybody wanted to live, like Florida? Florida, right? And I thought, okay, let's try that. So 15 years ago, I said, all right, we're done. I'm just tired of getting beat up in Cleveland, right? Demand supply thing was not in our favor. And so I started the process of getting to know the Florida markets. And now all we do, as we do this podcast, we're 100% in Florida, right? We're going to expand to other markets outside of Florida. But 15 years ago, we started that process. We syndicated a few deals. He has since retired. I no longer need that balance sheet liquidity, assistance. So he and I syndicated a number of deals together. And then I think when he retired, I'm trying to get the timing right, but I think that's right.
Sure.
I decided, you know what? It's really competitive in Florida, right? Everything in my life seems to have happened out of necessity is what I've learned looking back. So, when a 30 offers come in on a deal in Florida, because that's the way it is, they're all syndicated. And so, Mr. Broker, I promise you I will raise the money. He's like, yeah, that's what everybody says. So I thought, you know what? I got to go raise the money first, because then I will be differentiated. I will rise above them. I will get better deals, blah, blah, blah. All of the things that seem to make sense if you have the money in the bank. And I wasn't wrong. That's how we now buy. We're on fund number 4, and it continues to go well. But no, as this has evolved over time, as you get more experience, as you understand investors better and the business better, now this is how we buy. And I wasn't wrong, right? When we flipped that model from, getting the deal, raising the money later, to now raise the money, get the deal, that process works so much better. Because I mean, what broker, when you tell them and you legitimately have $15 million to spend that's already raised, they're
Sure.
going to listen to you.
Of course they are. Of course they
They're
are.
going to listen to you.
Yeah. So let's talk about that a little bit because the avatar of this audience, most people on this audience are new or newer passive investors.
Hmm. Yep.
I generally deal with single asset syndications where we're bringing
Hmm.
dollars to an already identified asset.
Yep.
Talk a little bit more about that process, about how you build confidence with your investors when you're essentially selling a buy box. You're not selling an asset.
Right.
How do you communicate that and build confidence in your investors that you're going to go out and buy what you say you're going to buy?
Yeah, that is a really good question. And it is the most difficult thing to get over when you start
Yep.
raising your first fund, because you don't have bricks and sticks to show somebody. You just don't. And
Yep.
so what you have to rely on is your track record. So what
Okay.
we did is our track record's on our website, but here's the CPA in me thinking, why is anybody going to believe my track record is what I say it is? How do they know? So I found this company called Veravest that at the time they existed for the purposes of vetting, hence the
Yep.
name Veravest. They vetted my track record. So 27 years, but at the time it was like 23 years of deals. I mean, that was, first of all,
Yep.
extremely expensive, but it was a brutal process, right? I keep good records because I'm a CPA, but I had to
Sure.
get tax returns and settlement statements and purchase agreement. I mean, you bank everything, you name it. We
This
went through
this
that
is essentially just like this is
an
like
audit.
audited financials for a track record, right?
Yeah, they made me prove everything to them.
Okay.
So our track record is on our website as a screenshot of what's on their website.
Love
So
it.
you can actually click through from our website to their website. They just want your name and email, and you can see on their website our entire vetted track record. Now, they no longer do that. Unfortunately, I think the latest deal we bought was a Levi in early 24. They no longer in that business. I assumed that they just didn't
Hmm.
like the risk. I don't know. Maybe they couldn't make money. I don't know why they stopped. But,
Interesting.
they said, look, we'll leave on our site what we've already vetted. That wouldn't be fair to you, collect literally 5 figures from you and then dump you, right? That wouldn't be
Sure.
fair.
Sure.
But they do annual SEC background checks, criminal background checks on me every year that I'm on their site, because obviously they have their reputation to protect. But
Sure.
so
And
that,
what's the name of that? What's the name of
yeah,
that company again?
it's called Veravest, Verivest. So they won't vet
Very
anybody
good.
new, but at least you can see our track record there. Or you can just go to our website, KRIPartners.com, click through, and you can get to their site. That's probably even easier for you to
Yeah.
find.
Yeah. And what a great, I'm just thinking about, like, I'm constantly vetting operators, vetting deals.
Mm-hmm.
That's literally,
Mm-hmm.
I left corporate America because I didn't want to work as many hours, and I'm probably working twice as many hours now as I
Right.
ever have.
Yep.
But yeah, to be able to go to a third party that essentially will review and verify those information, what a tremendous offering that would be to have access to that. Because I see deals every single day that they suggest this is our track record and here's our returns, but how do you know? Right?
Yep.
Just like,
That's
how do you
right.
know a performer is going to actually equate into numbers? How do you know that their track record is actually that? So kudos to you for certainly opening up the business and sharing that. And that I suspect is what allowed you to get the confidence from your investors to do that first fund.
Well, that and a lot of things, right? People have to that trust factor has to really go up. And so what
Yeah.
we know is that people try to experience us in a lot of different ways before they
Okay.
pull that trigger and say, yeah, I trust you enough, right? They have to be in situations where they can ask me any question that they want to. They're going to get a meaningful, legitimate answer. You can tell when people are BSing you. Most people can.
Yeah.
It's that kind of stuff. So it's a combination of all these things. And you do a lot of money raising. I always tell people, I want you to follow 4 rules. You got to make sure that whoever you're investing with has experience, and that means has the experience so they know how to deal with whatever's coming next, like 500 basis point in rise in interest rates, COVID,
Right.
all the crazy things. Second, track record, that they've actually taken deals full cycle, so that they actually can make money. You want them to be transparent, right? That makes sense, because
Yep.
you got to have transparency. And the last thing is you got to make sure they put you first. They got to put the investors first. That's really, really
Okay.
important. A little harder for a lot of new investors to figure that out. But if you, I just tell people, look at the fee structure, just ask yourself, can they get rich and you not? If that happens, then you need to move on to the next.
Awesome. So for the newer investor, dig into that piece a little bit. Like what are some questions they should be asking? What are some metrics they should be looking at to really understand if their interests are being looked at first compared to the operators?
Yeah. So the first is fees, right? As you know, the more people you get in the GP pool, the higher the fees because everybody wants to eat, right?
Yep.
And the pie has to be bigger. So it's usually fees is the first obvious thing. The second thing is making sure that you can get your capital out before they do. Third thing is making sure you stay in the deal. Don't let them refinance you out. Some people do that. It's pretty rare, but that's just brutal in my opinion. If you take the risk with me on day one, you should be there on day whatever, the last day to reap the profits. That's how I feel. So those are some things you can do. I'm trying to think if there's other things. It's usually the piling on of fees that people don't. They just and I would tell your listeners, don't be afraid to ask whatever question you have. If it doesn't feel right, then you need to go ask. Don't worry about offending the sponsor, the fund manager. If they're that easily offended, you don't want to be in business with them. They should expect the hard questions. I get them, and I appreciate them more than investors who don't ask, because investors who don't ask, they're not thinking it through as well as you would want.
Exactly.
You know what I mean?
Yep. Yeah, no, I think the tough questions in due diligence process, that's really what differentiates the more sophisticated to the non-sophisticated or unsophisticated investor. And one thing that I've started doing recently, and it have actually been the reason why I stepped away from my last 5 deals, was that I've started to ask for the most recent either monthly or quarterly reporting that has been shared with investors on their entire portfolio. And a lot of people, you ask the questions about the state of the current portfolio and what's going on with the health of these different assets, and you'll get a response. But then when you ask for the actual reports that they've been sharing and the financials, very quickly you can see whether they were telling you the truth or not. And if they weren't telling you the truth, then that's a big red flag and a sign that it's time to move on. And for the operators that aren't willing to share it is another red flag. And I've had a number of those too.
Problem.
Exactly.
See, it breaks my 3rd rule.
Exactly.
See, I'm telling you, those 4 rules work, man. Think about them. Every time you see a deal fail, not always, I can't make it perfect, but most of the time, 1 or usually 2 of those rules are broken.
Yep.
So imagine if the fact that you're going well. How transparent are they going to be with you then?
Right. And when you ask them if they're all going well and they all say perfectly, that's another red flag, because better than I do that nothing runs perfectly and there's all kinds of issues. I do also like the fact that you talked about, this idea of the European versus the American waterfall, whether people get their equity or their capital back before the operators start earning their own returns on the back end. And that very simple adjustment can have a big impact on returns and the risk profile of the deal, quite frankly.
Yep.
So good stuff. Well, let's dig in. So today you currently have a couple $100 million in AUM and 14 full cycle deals. How is your portfolio performing today? What does that look like?
Perfectly. No, I'm just kidding. That was a joke. It's going well. So I'm a risk manager. So I want you to think back. 27 years means I went through 08, 09.
Yep.
So remember I talked already a little bit about discipline. I don't get as many deals as I'd like. The number one frustration that our investors have is that they commit and I don't get them a deal fast enough. I'm just telling you, that's their number one complaint. Why does that happen? Because I stay disciplined. I'm trying to go in at even leverage. That's the first thing I'm trying to do. And the second is I want legitimately $200 to $300 in upside in rents. Now, so there's a reason I'm telling you this. And I'm telling you that because the people that are in trouble right now or have been in trouble over the last year generally made one or of 2 or maybe both mistakes. Number one, they didn't manage their debt properly. They thought, okay, I've got a 3-year business plan. I'm going to put 3-year debt in place, and that's all I need to worry about. Well, the world never works out perfectly. And so I don't like that plan. If I've got a 3-year business plan, I want at least 5 years in debt that I can be comfortable with, right? So
Yep.
the first thing we did was nail down all of our debt. It's all fixed. I think the shortest term right now is 3 years left on remaining term. So that's the first thing we did. The second thing we did is, remember, we're in Florida, so insurance rates went up, some property tax went up, all those things moved against us. How do you think you're going to pay for that? With the $200 to $300 in upside. And so our discipline is, and this is part of the reason we don't get as many deals. On day one, my goal is to rent at what I think the projected new rent should be without doing anything. So if I think there's $300, I'm going to throw that first unit out there without doing anything and get as close to the $300 as I can. And I expect to get close. Why? Because I've already done the work. Here's the work part. You've got to go do a legitimate rent survey. You got to visit comps. You got to actually do all this work. And if you do, and you understand your market just like a prospective renter would, you know what you can charge for rent today and what you can't do. And so that's why we don't get a lot of deals or don't do a lot of deals, because those deals, I mean, they're not everywhere. So you got to look hard and find them. So our deals are all cash flowing. Our target has always been 6%. We're cash flowing 6% on everything. And I suspect, I mean, if you were to value them today, the rise in cap rates has probably put them at best, probably break even, maybe a little more still. But as soon as we get cap rates coming down even a point, which they will, especially in Florida, we're going to be just fine. So I've learned a long time ago, this is the '08 lesson now. Just make sure that when things get tough, just make sure you don't lose your property, because these are multifamily deals. This is housing. Everybody needs a place to live. There's probably going to still be a need for your apartment complex, right? You just got to get yourself through the bad times. And so how do you screw that up? By not having the upside, hiring third-party management that's not careful. We always manage our own stuff. There's some good third-party managers. I just know what sometimes can happen. And make sure that you manage your debt. So because of that, our portfolio is doing fine. I mean, it's not throwing off 10% or anything like that, but I'm pretty sure we'll meet in all of our cases mid-teens annual returns when we sell these properties.
I love it. I love it.
It's all because of risk mitigation, though. I want you to realize that, right? It's staying disciplined. And I mean, if you have a 100-unit property with $300 more in income per unit, I mean, that's a lot of new income to fix a lot of problems. You agree?
Absolutely. Absolutely. Yeah. So you have a very disciplined approach to finding the assets. And when you combine that with the fund structure that you're using, what does it look like from an investor standpoint from the time they commit to their dollars actually getting deployed? Are they earning returns from day one, or are they waiting 3, 6, 9 months for capital to be deployed?
That's a good question. So let's say you committed today. Our minimum is $100,000, and let's say we had a deal, right? Maybe half of your commitment we'll call right away, right? We'll spend right away. The other half sits in a temporary investment account. We use PNC. They're paying like about $475 right now. That all accrues directly to your benefit, not to mine. So in theory, every time we close a deal, it's because we have a deal. When we close a fund, it's because we have a deal. And then we typically have undeployed capital that we're trying to deploy as quickly as we can. And a good example of that is our Fund 2 it still has about $5 million to deploy, and our Fund 4 has over 10 now to deploy. So those two will go together to buy probably the next deal. So we'll generally try to do 2 deals in each fund, keep rolling it forward, because we always want to be in a position to always have a place for investors to put capital. And 2, we always need to be able to say to brokers, we have the money in the bank, because that's what makes us a strong buyer. And you just don't know when that next deal is going to come. And if you spent everything and had to start over, I mean, we're pretty good at raising money. We've raised $46 million, but it takes a minute to build that bank back up so that your brokers know and the sellers know that you've got the money. Does that make sense?
Your investors are also getting diversification across 2 assets then as well, right?
Yeah.
Okay. Interesting. I've not heard that model. Generally, when I hear the fund structure, people are raising funds and they might plan to buy 5 or 6 assets in any given fund. I've not heard this 2 asset strategy, but I like that, and it makes a lot of sense why you would do that. And I love the benefit to the investor.
You know what I like about it? Here's what
Yeah.
I like about it. The people that are using funds to buy 5 or 6 assets. So I want you to think about this. When we buy the first deal in a fund, we close that fund to new investors. It's closed. Nobody else is allowed in that fund. Everybody's relative percentages are set. There's a lot of reasons I do that, the least of which is it is impossible for me to have new people come into a fund to fund distributions to the people that are already there. Think about that.
Great. Yep.
Can't do that.
Standpoint.
It's closed.
Yep.
The other reason I do it this way is I want you to think about you're in a deal, and now Ken's going to allow second round investors in, right? But here comes your neighbor. He's like, how's that deal doing? Oh, it's killing. Okay, I'm in. Well, he just diluted you.
Yep.
Right? He would only do that if the deal was doing well, right? What if the deal sucked? He looks at you, he calls you, you're like, don't go in this fund, man. This thing's tanking. He stays away. You don't get diluted. How is that fair to you as the first round investors? So I can't. I know the world, the institutions have a way to make that fair and equitable, but retail investors, nor do I, feel like I can really right that wrong. I mean, it's like placing the bet on the game on Monday morning.
Right.
And you're not betting on Monday Night Football, okay? You're betting on the Sunday game.
Entirely different risk profile at that point once the asset's been acquired. Yep. Interesting.
Yeah. So anyway, that's why we do what we do. And there's a third reason. I don't like big, huge funds. I just don't. They're too unwieldy. It's just too much. I'd much rather have funds that are 10 to 20 million and just keep rolling those. That's fine. That serves my purpose, and that gets it done. So at least for now, that's our plan.
Okay. Well, very good. Yeah, I've learned a couple of things already in this conversation. Thank you so much for that. Curious your thoughts on the outlook in the coming years.
Yeah, I think I think we're going to see a lot more deal velocity coming forward. Here's why. The only people that are selling or have been selling are the people that have to. Yeah. Right. They just have to because they're being forced to because of expiring rate caps or maturing debt. So they've got, and rates moved up and their income didn't move up enough to offset that. So they're selling. They're in a tough situation. But the people that have good assets that didn't have to sell, they're not selling. That doesn't mean they don't like to turn money. That just means they're not going to sell into what they consider to be a bad market. Well, that means there's a lot of product sitting there that has not been offered for 3 years. That's all going to come on the market. I think there's going to be tremendous velocity. You're going to have rates come down some. So it's just going to make it a very palatable experience for both the buyers and the sellers, right? That's part of the problem right now. Velocity is down because the sellers don't want to come down and the buyers can't come up, and you have this separation. But I just believe that the balance, well, it's probably going to be 25, 26. Things are really going to, assuming the Fed doesn't jack rates back up, and I don't think they will. But assuming rates continue to trend down, you're going to get a lot more deal velocity. That's what I believe.
So what are your thoughts on if we see this huge flood of assets hit the market, what is that going to do to cap rates? Do you think that's like supply and demand tells us as supply goes up, demand's going to go down, right? And that's going to have an impact on prices. But I'm hearing many, many different stories and different vantage points on this. I'm curious your thoughts.
Yeah. So if you just look at demand and supply, will cap rates go down? Probably. But I'm used to depressed cap rates because I'm in Florida, and everybody wants to be in Florida because of the growth expectations, right? I don't see that changing. So we're always going to have relatively low cap rates. What is important is the way I come to market. Remember, we're not, you don't have to worry about us raising, we already raised the money. Yeah. Mr. Seller, Mr. Buyer, or I'm sorry, Mr. Broker. And remember, we've been doing this for a while in Florida, so our reputation is pretty decent, right? We don't retrade people, we don't screw them, or we don't jerk them around, and all that stuff. So we will likely get better deals. So far, we have, and I think we will continue to get better deals than the syndicators because of the certainty of close. I mean, we can deliver a lot of things that a syndicator can't deliver. And remember, I've been a syndicator, and I'm not knocking syndicators. You got to do what you got to do. my syndications, I usually had to pay up to get them. I just did.
Yeah.
We still did
Yeah.
well, but it still sucks to pay up and
Yeah.
rather not pay up.
Yeah, well, and that's a good point too. And I think you find as operators become more skilled, they have more track record and history. You see their returns start to drop slightly as well as compared to maybe some of those other ones. Syndicators that are a little more aggressive and giving more of the deal away. So I'm curious, how do your deals compare to comparable assets at the marketplace from a return standpoint?
Yeah, so our target is always mid-teens annual rate of return. 6% cash on cash is part of that, and the rest when we sell. So
Okay.
our track record's there. So if I go backwards from the last deal we sold, what did we sell last? I think we sold Whispering Oaks. Got to look. I'm doing this from memory now. I think the annual rate of return was like 36%. We held it for a little over 2 years. Not bad. The one before that was Belle Reve Club. We sold that. We held that for 3.5 years. That was in Jacksonville, and our return was about 22% annual return. What was the one before that? Why am I? Coachman Club, I think. Coachman Club was in Clearwater. I think the annual return over 2.5 years annualized was 30%. So those are just the last 3 deals. My track record's there. You can go look at every bit of it. I just can't. I don't remember that. I mean, Arbors at Garden Grove, we continue to hold. I mean, that deal's just been insane. Little bitty Winter Haven, Florida. Probably never even heard of it, have you?
Never.
Right. Little city between Tampa and Orlando. We bought 90 units. We raised $2.2 million to do the deal. So we bought it 8 years ago. We've returned everybody's money. We've returned another $1.8 million. It still cash flows. It's ridiculous.
I love it.
And they still have $5 million equity in the deal. There's no. I mean, the returns are ridiculous there. We moved rents, and here's the secret to everybody who's listening: you got to have this rent upside. We have moved rents at that property $665 a month in 8 years, and 30% of the property is under rent restrictions, and we've still moved it that much.
So let me ask you then. I'm looking. I'm working with an operator right now that is sitting on a very large portfolio. They've done exactly the same thing. They've refinanced out some of them 3 and 4 different times. They've been holding them since the 90s, right?
Yep.
How long do you hold those assets? Like, is there a point when it just makes sense to sell it?
Yeah, what happens is you really have to start paying attention to the building. So my Arbors at Garden in the market, right? My Arbors at Garden Grove deal was built in 2001. We had just put new roofs on it. So roofs are done. That is important, right? 23-year-old roofs. And we held back. So even though we distributed all that money, we held back $500,000. And we did that because it's an 01 build. It's 23 years old. I need to be able to keep up with the current. I need to continue to update the units and everything else. So that's what we're using that money for. So to me, it's more about that, right? How long do you want to hold? Now, what happens is when you have held something since the 90s, you've got very low basis. Now you got people freaking out about their tax liabilities, and you've got to figure out how to deal with that. So at some point, it's a little bit of a balancing act here. You want to be careful, because if you let the asset age too much, it depends on your market, you'll hurt yourself, right? Because then the big expenses will start coming, and instead of the
you need a cash infusion at that point.
Back in, but partners don't give you money back. That's not how it works.
Right. Okay. Yeah. Thanks for walking through that. It's something where most of the operators I've worked with, they've got pretty specific, we're 4 to 6 year holds. They sell them. They don't do the right refinance thing. But as my personal investment dollars are, I'm more of a cash flow investor today than I was when I was making big checks in W-2. So I want to see those dollars continue to work for me without having to, go find the next deal every 4 years. I would rather those dollars stay and just keep feeding me. So
So I in my mind, it's about the deal though. Now think about this: if you were in my Arbors at Garden Grove deal, knowing it's a newer asset, the floor plans are amazing. You if I told you, hey, I'm going to sell this thing, you'd want to hang me. I mean, you just would. You're like, what are you thinking? Like, why you can't? How are you going to find the next deal that's going to do this well? So that's now if it's a product built in the 70s, it's a completely different story.
Yep.
That's
Yep.
totally
Exactly.
different, right? So
Yep.
that's why I say it depends on the asset. Remember, this is a business. It has a lot of moving parts, and you have to make sure that you're making the right decision considering all of those factors. That's the experience part of the management team, the
Sure.
management team's experience that I'm talking about. Because
Yep.
if you do that same thing with the 70s product and you haven't taken care of the infrastructure of the building, eventually that roost, it's going to come home to roost on you. You're going to have to deal with that. And if you don't
Yep.
have the funds saved, again, your deal can go great, but I can guarantee you, if I call the Arbors Garden Grove investors and ask them to send me money, it's not going to go well. It just would never
No
go
doubt.
well. And you don't
No
want to have
doubt.
that situation. So,
Well, and I think to your point, like these are the things that somebody doesn't learn at a weekend conference, learning how to become a
right.
syndicator. You
Right.
learn those things by spending 27 years and being a CPA and gaining your initial skills from a company like Deloitte and your master's degree. So, yeah, very good. Well, this has been a fun conversation, Ken. I enjoy kind of the different perspective that you've brought compared to a lot of the folks that I've talked with, and I'm sure your investors love the returns that you've been providing them for years and years. So, if you don't mind, though, I do have a couple of questions that I still would love to ask. If you've got a few more minutes before we
I
wrap this
do.
up. All right.
Right ahead.
So let's, if we can, consider these questions from the vantage point of the newer passive investor. This is
Okay.
your high income W-2 employee that may be thinking about placing their first or maybe second or third LP investment potentially with you.
Okay.
So
All right.
when those folks are trying to get educated in this space, what would you say is the best place for them to go to start their education journey or continue their education journey?
Ooh, that's a good question. There are lots of people out there providing education for investors. I would encourage you to look at a good cross section of them, because let's be honest, most of them are there just to sell education, and they tend to just kind of give you a little bit of the details.
Yeah.
Remember, we do this, so I have to be careful. I don't want to, talk my own book, but whoever it is that you choose, you need them to go into the weeds with you, right?
Yeah.
The more you understand as an investor, that's what Warren Buffett says. Don't invest in stuff that you don't understand. Real estate's not that hard to understand, but you need someone to take you into the weeds so that you can understand it a little bit, so that you can ask better questions. So where would you go? I mean, I of course, I'm going to tell you should look at what we do, but compare us to any of the other investor education folks. Read as much as you can. I mean, you can learn a lot on YouTube. Just trust your gut. Follow my 4 rules. I'm telling you, follow my 4 rules. I think I have a book. I know an article on my website. I might even have written a book. I can't remember about those 4 rules, but they are going to serve you the best. They just will, because that's going to help you figure out who you should put your money with. And you're going to start to, if you follow those 4 rules, you're going to start to know who is the experienced one and who's not.
So, and a quick refresher on the 4 rules.
Yeah. So number 1 is experience. They got to have experience, right? And it's because you need a management team with experience, right? Just like we just talked about, should you hold the asset or not? Secondly, track record. Track record's one thing. Anybody can buy deals, but you have to know that they have taken them full cycle and been successful, right? Because they might just be kicking the can down the road.
And any thoughts on full cycle deals and track record over any particular time period? Do you like
the longer the better?
Horizon? Okay.
The longer the better. I mean, if they've been doing it, here's the thing: you got to be careful, because prior to Mr. Powell raising rates the way he did, if your heart was beating, you could make money in real estate, because all you had to do was exist. But now, right? If you look at the last few years, a lot of people have had a lot of pain. And it's just because of a few mistakes that inexperienced people made. They never, most of them didn't act with some criminality. They didn't understand data. Who'd have thought you needed to understand, finance when you're buying real estate? Well, guess what? It's a heavy capital business. You got to understand it, right? Who'd have thought that you got to understand the operations side of a business? Well, seems obvious to me, but everybody hires third-party managers, right? So there's a lot of reasons that these things ended up where they are. So you want to see the most you want to see in the last 5 years, what they've done, but the longer the better. We bought our first deal in 97. If there's somebody, I mean, if you go beyond 15 years, I don't know that it matters, right? Like,
sure.
First 10 years, does it really matter? I mean, if you look at my track record, the first 10 years, we used all leverage. We had ridiculous returns. It's because it was our own money. I didn't use anybody else's money. So I was willing to leverage 98%. I would never do that with your money, right?
Sure.
So just the longer, the better. But I think if you go over 15 years, I don't think it's kind of
okay. Okay. So the first two, third and fourth one then?
Yeah, the third is transparency. This is key, right? Think of the Verivest thing. Think of you asked your sponsors to send them the reports.
Yeah.
Well, that's transparency, my friend. And you should expect that from them, because if they're not willing to be transparent with you up front, there is no chance, in my opinion, they will be transparent with you when it struggles. So they just won't. And the last thing is they got to put you first.
Yep.
Right. Don't let them feed the daylights out of the deal. Because look, there's a lot of people that do this business for a lot of reasons. Our fees are 1% acquisition, 1% disposition, 1% asset management. You cannot possibly think our fees are high. I mean, they're the lowest anywhere. Why? Because the reality of it is, I know you're a cash flow investor, but the money is made in this business long term. The cash flow is just enough to keep you happy, right? You're doing it because it matters. But that's not why the Arbors of Garden Grove investors are thrilled. They are thrilled because they got their money back and then some, and it just keeps on giving, right? Yeah. That's the money in this business. So if you have people feeding up these deals, it's just, I mean, imagine a 2 or 3% asset management fee and a 3 or 4% acquisition. I mean, you're just like, man, I mean, you got to make a lot of money just to pay all the fees.
Good point. And I've never heard 1%, 1%, 1% before. I've never heard that fee structure before. That's hands down the lowest fee structure I've ever heard of. So
yeah, but it's because I'm not here for the fees. I'm here for the long term. Remember, we have to align our goals. If I can't align my goals perfectly with you, if I'm getting big fees, guess what? We become misaligned. Yeah. Right? Because now I'm encouraged to turn the assets, earn my acquisition, earn my disposition, make deals that maybe I shouldn't make. You see what I mean? You see what happens?
Yep.
And that's why it's just friction. Plus, every penny of fee is, usually 80 cents. We're 80-20 on our split, right? A lot of people will get a lot more aggressive.
I know we're in the final questions here, but I got to ask this question. Do you offer preferred returns with your investors, or do you see? I feel like preferred returns can almost offer the wrong incentive to the operator. So I'm curious your thoughts.
Yeah, we used to do preferred return. And in Fund 4, we stopped. And here's why. So I'll try to be brief. There's 3 things that happen to me when I have a preferred return. Let's say let's say my pref is 6. And so, okay, you're going to go in my deal. I told you get a pref of 6. I said, but it's cumulative. So if I don't pay you in the beginning, it's okay. It'll accrue. Yep. And then now I find a deal, throws off 4.5. So I do the deal. Pretend I do the deal. I give you 4.5. You immediately think I'm failing you. Whether I told you it would accrue or not.
Okay, sure.
You're looking for a 6 pref. So now right out of the gate, you're a brand new investor. I have already frustrated you. That is not a good experience.
My first investment, I had that exact same experience personally, because I was not as sophisticated at the point.
What do you think?
I was frustrated because I didn't get my pref year 1. Yeah,
that's right. Exactly. That's exactly right. I'm so glad you asked this question. We did not set this up, I guarantee you. So what's my alternative? My alternative is to go into my pocket and pay you the 1.5%. Well, I mean, come on, man. We don't go into business to give money away. So that's option 2 fails as well. So what's option 3? You got to pass on the deal, because I can't make you happy. I can't make me happy. So now I'm missing out on a deal that I believe would be really good deal long term because of this stupid pref. And that's why I dropped it.
And I would argue, Ken, that if you do keep the deal, you've got this compounding or the accruing and potentially compounding pref that doesn't allow you as an operator to earn a single dollar until you sell the thing, because there's not enough cash flow to support that. So, no, I thank you for digging into that too, because I've gone back and forth on this. I mean, the traditional retail investors, they want to see a preferred return. And I think we want to see preferred returns because we've been taught to expect preferred returns. But I believe that it's extremely important for the operator to be feeding their business machine to keep the lights on and the doors open, to make sure that those dollars are taken care of in a longer period, and not so dependent on the acquisition fees on the front end or the disposition.
If you have a
fees.
deal if you have a deal that's not performing and you know you got to work on it for the next 7 or 8 years to make sure your investors are whole, but you're not getting paid a dime, I'm just, look, that's not a real reason, right? But I'm just telling you, I've never had that situation, but I could just imagine sponsors paying less attention. So like, guys, I'm not getting a dime out of this. What do you want me to do here, right? I don't want a sponsor. I don't want to be in that situation. The other thing I would tell you, if you're in an 80-20 split, the pref only matters if the whole thing earns less than 7.5. You know that, right? 6 plus 1.5 is the other 20%. So as long as you're making 7.5, I guess that's possible, but I would consider 7.5 a massive failure for the way we do business. Sure. I can't promise anything. You know that. Neither can you. No guarantees. But that return has to get pretty low for that prep to actually matter.
Ken, I feel like I can keep talking all day here. I want to be respectful of your time and the listeners as well. So let me ask these final couple of fun questions. Okay. And then we'll just probably have to reschedule and do this again at some point, Ken. This has been a lot of fun.
I would love that. You guys are great. I love talking to you.
Yeah. All right. So let's see here. We've talked a ton about the due diligence process. So I want to ask that question. So a couple of fun ones here. If you're a guy that has a bucket list or has chases after bucket list items, have you recently checked a bucket list item off your list, or are you hoping to do so here in the near future?
Yeah, late last summer, my family and I, my wife, my kids, we all went to Europe. Hadn't been. And we loved to cruise. So we did a Western Med cruise on Royal Caribbean. And if you've ever go to Europe, man, that is the way. Just every day at port, you get to see a lot of different things come right back to something you're familiar with. So that's my bucket list. That was huge. My wife is dying to go back.
I love it. Congratulations on that. That is, we have been around Europe, and we've done cruises, but never the Mediterranean cruise, which I'd love to do. So, all right. And a final question here. If you had $100,000 you needed to invest this week, but you couldn't put it into one of your own deals, where would you place that capital?
Yeah, where would I place that? I would probably put it in someone else's real estate deal.
Okay. I'm real estate through and through.
I don't do the stock market anymore. No.
Very good. Very good. Well, Ken, this has been a lot of fun. I've really enjoyed the time together. I learned a lot, and you've confirmed some things for me as well. So thank you so much for being on the show.
I appreciate it. Thanks so much for having me.
Awesome. All right. To the listeners, as always, we can urge you to continue your education process in this passive investing space. And more importantly than that, we encourage you to make the decision to place that first investment. Both Ken and I are convinced that once you do, you will be so happy that you did and just wish that you had done it that much sooner. So be sure to join us again next Thursday for another great episode.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.